Good morning, Quasar Markets Live. We got him here today, Alan Ellman. We've got a good one today. Obviously, options are on everybody's tongue right now, and what's really cool is I'm liking this one, Alan, because people are starting to look to protect their portfolio a little bit more, and how because now here we are at all-time highs again, the Qs and the Dow again breaking 50,000, and you've got a really good one today. It's how to establish a bear market cash secured put trade, and I'm gonna leave you alone. I know you know your things. Here we go, man.
Thanks, Steve. Okay, what I'm going to talk about today is cash secured puts. Now, if you're in a bear or volatile or concerning uncertain market, you're going to want to set up this trade in a defensive posture. And in this presentation, I'm going to show you how to do that. And I'm going to be using a real life example with Solaris Energy Infrastructure Inc., listed on the New York Stock Exchange under the ticker symbol SEI. And these are three trades that I actually executed in one of my options portfolios. So these are three contracts. Now I do between 100, 150 a month. So I'm going to show you this particular three trade series with Solaris, understanding that this is only a small amount of what I have actually done this month. So Steve, if we can move on to the next slide, we could first begin to explain to the Quasar audience what we're doing here. When we sell cash secured puts, we are undertaking the contractual obligation to purchase shares at a strike that we determine, that's called the strike price, by a date that we determine, that's known as the expiration date. Now, in the BCI methodology, blue collar investor methodology, I favor predominantly out of the money put strikes. So, for example, if a stock is trading at 75, I may set my put strike at 70 at a lower price, agreeing to buy it at a lower price than it's currently trading for. For puts, that 70 strike is known as out of the money. Now, in bear market environments or concerning market environments, we may want to go deep, deep out of the money. In other words, much lower than if we were doing traditional cash secured put trades. That means that those shares will be put to us, if they are in fact put to us, at a much lower price, giving us more protection to the downside. And that's what I did in these three trades, as I'll show you in a moment. Now, how do we quantify the risk of exercise, the risk of those shares being put to us? Because we may not, in fact, want those shares put to us. We may just want to generate cash flow by selling those options. Well, there is, in fact, there are a couple of ways of doing it, but I'm going to show you using delta, one of the option Greeks, to determine which strike price to select, how much premium you're going to generate using that strike price, and what the risk, in fact, is. So let's now move on to the next slide, and we'll discuss what is the option Greek delta. Now, delta has three different definitions, but the one appropriate for today's discussion, Steve, is the probability of a strike expiring in the money. So in that example I just gave before, if a stock is trading at 75, and we talked about the 70 out of the money cash secured put strike, well, that 70 out of the money put strike will become in the money if the price of the stock drops below 70. So delta will tell us what the approximate probability of that happening and therefore being subject to exercise are those shares being put to us. Now, typically put sellers, they don't actually want to be share owners. They basically want to just generate cash flow, right? So the delta will actually measure that risk of exercise and quantify that risk. As we go deeper and deeper out of the money, or much, much lower in selection of the strike price, our protection becomes that much greater. But the trade-off is the option premiums will become less and less. So we must actually find a balance between the risk of exercise and the actual returns that we're generating when we sell our puts, because after all, our goal is to generate cash flow. Now, as it relates to cash secured puts, Steve, we may also use this strategy, and it's a great strategy for purchasing a stock at a discount. And when we do our calculations, you'll see how that works. Okay, let's move on now to the next slide. And we're going to set up a real life example with Solaris. And on January 22nd, 2026, when I set up these slides, Solaris was trading at 56.95. Now, Steve, I took a peek at what Solaris was trading at just before we went on the air, and it was trading at 52.01. So it's dropped almost $5 a share. So for 300 shares, and that's the obligation you'll see that I took here with this trade, I'd be down 1,500 bucks if I just bought the shares. But that's not the case. I sold deep out of the money cash secured puts. So I'm actually in pretty darn good shape, as you'll see. So what we're going to do is we're going to look at an option chain and look at strikes with deltas under 10%. That means less than a 10% chance of being subject to exercise. Let me incorporate the adjective approximate risk of exercise. Okay, it's not 100% precise, but it is a great metric to use to measure how much risk we're taking. Now, you'll note on the option chain that's coming up that deltas for puts have a minus sign before them. So, it'd be minus 10 or minus 8 or whatever. That's because there is an inverse relationship between the price of the stock and the value of the put option. So the price of the stock goes up, the value of the put option goes down, and vice versa. That's the purpose of the minus sign. But the real important part is the number, and that will quantify the risk of exercise. So, Steve, in the next slide, let's have a look at the Solaris option chain here. And what I did was I highlighted 3 different strike prices. So let's go through those 3 different strike prices now. And you'll see at the top that in the red oval on the top left, that this is for an expiration on February the 20th. And I made these slides on January 22nd. So it's about a month out, right? And at the time, as I said, Solaris was trading at 56.95. So let's have a look now in the pink row over there. You see at the top that the pink row had a 35 strike. You'll see the delta of that 35 strike was 4%. That's in the green oval. So a delta of 4%. That means there's a 4% risk of exercise of the price of Solaris dropping below the 35 strike. Now let's go to the 37.50 strike in the yellow row, and you'll see here that there is a 6% risk of exercise, once again in that green oval in the middle row there. And then if you go down to the 40 strike, you'll see that there's about a 9%, 0.0885% risk of exercise. So those are the 3 deltas, 4%, 6%, and almost 9%. Now, if you take a look at the blue oval in the middle of the screenshot, you'll see the actual bid prices we're going to be getting by selling those particular strikes. So the 35 strike had a bid price of 20 cents or $20 per contract. The 37.50 strike had a bid price of 40 cents or $40 per contract. And the 40 strike had a bid price of 70 cents or $70 per contract. Now, when you're evaluating these option returns, you must do it on a percentile basis and an annualized percentile basis. So you compare it to other forms of investing, like let's say risk-free investments like a CD, which right now is generating maybe like, say, 3.5%, something like that. So you can kind of be able to compare apples to apples. So let's now, Steve, move on to the next slide and actually do some of these calculations, bring it back home to the risk of exercise, and then see which strike we're going to select. Now, I actually did one of each in my own portfolio. Now, in the top of the screenshot, what you're looking at now are the entries that I put into the trade management calculator, a spreadsheet that I developed for covered calls and cash secured puts. Now, you notice the price of Solaris was $56.95. We talked about that before. And the 3 strikes are 35. That's the deepest out of the money or the lowest, 37, 50, and 40. And you remember the bid prices, Steve, 20 cents, 40 cents, and 70 cents. I did 100 shares of obligation for each of these strikes Again, keeping in mind, I do between 100 and 150 contracts. So these are only 3 of them. Okay. And I did these in a very, very defensive way. Now, on the bottom left, you'll see that it's a 30-day trade if taken through contract expiration. And highlighted for you in the yellow cells are the break-even price points, which is simply the strike price minus the premium. So those are the break-even price points. Notice they run from 34.80 as high as 39.30, keeping in mind at the time that I entered the trade, Solaris was trading at 56.95. So it would have to drop from 56.95 to below those break-even price points before I even lost a penny. So I think you could start to see now how much protection we have when we use these deep out of the money put strikes. Now let's go back to the calculations, bring it home and tie it in to the deltas, and we can see how much we're generating and what the risk of exercise is, and that will help guide us to which strikes we're going to be using. So let's look now at the 35 strike. In the brown cells, you will see the initial returns. So for that 35 strike, the initial return, that's the deepest out of the money strike. So that's the one that's going to give us the lowest return. And that was 0.57%. And based on a 30-day return, that annualizes out to 6.99%. So what is that? That's about double a CD, right? So you can have 2 times that of a CD. What's the risk of exercise? That had a delta of 4%. So 96% of the time, we would have to take no action at all to avoid exercise. If the price plummeted below that 35 strike and we didn't want to take possession of the shares, what we have to do is buy back the option before 4 p.m. Eastern time on expiration Friday. So that's the 4 delta 35 strike. Now let's move to the pink cells, which is the 6 delta 37.50 strike. So that was a delta of 6%. And in the pink cells, we'll see that the return was 1.08%. And based on a 30-day trade, that annualizes out to 13.12%. And so that's about 4 times what a CD will generate. Risk of exercise, the delta was 6%. Okay, and finally, in the gray cells, we see that the 40, still deep out of the money, but the highest of the 3 strikes, and that's the one that's going to generate the greatest premium, generated 1.78%. And based on a 30-day trade, that annualized out to 21.67%. And that's about 6 times that of a CD. Now, the last thing I want to show you on this particular slide, Steve, before we kind of sum everything up, is the purple cells. Now, the purple cells will show you if, in fact, the price of Solaris drops below those individual strike prices, right? We're going to purchase those shares at the break-even price points, which you could see in the yellow cells. What percentage discount are we getting? So for the 35 strike, we're getting a discount of 38.89% if we purchase it at a price of 34.80 break-even. For the 37.50, the break-even price point is nearly 35% discount. And for the highest 40 strike, it would be about a 31% purchase discount. So those are the 2 possibilities, Steve. Either generate cash flow, or if the price of Solaris drops below those strikes, we're going to purchase it at discounts of 31 to 39%. Those are the 2 possibilities. Now, let me bring this home, Steve, by saying this again, and I'll say this every single time we talk. The strategies that I'm talking about, covered calls, cash secured puts, are low risk strategies. They are not no risk strategies. So even if we purchase a stock at a discounted price of 35% from when we entered the trade, it's still possible for the price of that stock to go lower than that, in which case we could start to lose money. But look at all the protection we have when we sell these deep out of the money put strikes. But as always, when you enter these trades, you also have to be prepared with your position management skill set, exit strategies. So what will I do if the price of Solaris takes a nosedive, even worse than the put strikes? What are we going to do? You have to be prepared for that. What if the price of Solaris goes to the moon? Well, a lot of times you could roll up that put strike and make even more money than you're seeing now with these calculations. So right now, as these trades stand, Steve, there's about 8 trading days left before the 20th, and Solaris was trading at about 52 before we entered this discussion, and so I still have humongous amount of protection to the downside. So things are looking good, but I am ready if the price drops significantly lower. So let's sum everything up on the last slide I believe we have here. In bear markets, this is a wonderful strategy because it gives us so much protection to the downside, yet we could still generate significant annualized returns, especially when you compare it to safer investments like money markets or CDs. Now, delta is a very valuable metric we could utilize to measure the risk of exercise, particularly since most put sellers really don't want to take possession of the shares. There are exceptions. I mean, there are times when I'll purposely sell a cash secured put to enter a covered call trade. A lot of people refer to that as the wheel strategy. We're using both strategies in a multi-tiered option selling strategy. We've talked about that before, Steve. So we can balance the risk of exercise with the premium returns, and that will guide us to the most appropriate put strikes based on our personal risk tolerance and our overall market assessment. And there you have it, Steve, a great defensive play. Steve, I can't hear you.
And that should help a lot of people when they come into this. I mean, there will be a bear market. We look at that now, right? And try to find out whether or not the market is pushing up. But this is a great way to put those positions that you may have on it to put that bear market put on.
Yeah, I mean, you could still be aggressive in your overall market assessment and sell a put just to have a little protection in the short run. And again, if those shares are put to you, you could sell an out of the money covered call and then become aggressive. So we're doing short term trades here. So you could be defensive, you could change it in a couple of weeks and become more aggressive based on what's going on in the market today. Steve, you know better than most. It wasn't all that long ago that people were worried that the market would be crashing, right? And now all of a sudden people are feeling good. As you said, the Dow's reaching all-time highs, Qs are going up. So yeah, you could craft your trades to what's going on today.
All right, everybody, bluecollarinvestor.com, thebluecollarinvestor.com. Click on the button and go check out Alan. He will answer your emails. I know he's a good guy, man. He'll tell you, he'll ask you, answer any question you have. Alan, I'll see you back here next week, my man.
Take care, Steve.